Have you ever made a mistake that you've really come to regret later? Well, if most of us are being honest with ourselves, the answer is yes. We've all made a bundle of mistakes in our lives, but what I'm here to talk to you about today are three big mistakes on the tax side of things that I see way too often being made by entrepreneurs, especially those who are going it alone or maybe are newer to whatever business that they own. And what I hope to do by the end of today's video is educate you so that, especially if these are mistakes that you have made or are heck not even aware of, that they prevent you from making even bigger mistakes down the road, or that you can fix them so that they aren't made going forward. Hi, I'm John Norberg, and welcome to the Financial Prof series. So let's talk about this. Mistake number one, right? What is the biggest one that I see almost way too often? It's mingling business expenses and personal expenses, right? It is very important as a business owner, and hopefully you've heard this before, but it is extremely important that you have a business side and a personal side to your finance situation, right? So you should have business accounts, be they credit card accounts, bank accounts. Hopefully you have a business-only bank account. That's a step one, right? And that is for business. And on the personal side, obviously you have all of your personal accounts, and none of the twain shall meet. And the idea behind this is twofold. One, from a tax perspective, it keeps things nice and clean so that you keep your CPA or accountant team happy. And also two, from an asset protection side, right? Because what can happen, unfortunately, is if, let's say, things go south of the business or someone decides to sue you, or for whatever reason, there's legal trouble. Whoever is suing you or going after you or what have you, now, if there's commingling of assets, can, even if you have an LLC, potentially get at the business and the personal side. So instead of having this wall of protection that, LLCs and similar structures are supposed to erect and protect, the personal side now becomes part of the suable, if you will, assets potentially, because there was that commingling. So again, step one, business and personal expenses being mingled. Got to have those two separate. All right, number two, having the wrong kind of retirement plan. Now you might say, well, this is kind of niche, John. I've only been in business a year or two. I don't even have a retirement plan quite yet. I know it's something I need to do. But here's the thing. When I do see business owners set up a retirement plan, typically it's because now the cash flow is going strongly enough to where they can support themselves and some additional contributions for retirement. And they just pick whatever's going to be the cheapest option. This can be a bad idea for two main reasons, right? Reason number one, because if you're going with the cheapest, lowest bidder option, you're not necessarily going to get the level of service that as a business owner you're going to want for yourself. And also because it might end up meaning that because there was that lack of support, especially in the initial setup phase, that whatever you did pick is going to be the wrong format. If not right now, maybe, then definitely perhaps down a couple years down the line. Quick example, I'll give you a story. I have a doctor client who some years ago had set up a SEP IRA, SEP IRA, and it was going along great. He was able to stick away tens and tens of thousands of dollars every year for himself, get a nice big fat deduction on his taxes, which is great. But then as he started hiring more and more employees, and some of these employees were older and started getting more tenure, what he ended up having happen was there came a year, about half a decade into this plan, where he ended up having to write a very large, very unexpected check for that SEP IRA match that he was obligated to make. Now, once he got past that, he realized, shoot, this is going to happen again next year, but it's going to be even bigger because I have even more tenured employees. What do I do? And that's where he came to me and said, well, what other options do I have? And that's where we decided, in his particular case, a 401k with a profit sharing plan would still allow him to stick away a similar amount in terms of the tens and tens of thousands per year he had been doing, but also recognize employees for their service without necessarily having to shell out, again, tens and tens of thousands of unexpected dollars in employee match. And he could have some level of control over that. So again, using no retirement or the wrong kind of retirement plan is mistake number two. And then finally, mistake number three. This is not taking advantage of legitimate deductions, right? So this can be the simple stuff. Let's talk about, tax deductions on your mileage, on your cell phone, on a new laptop. Most people know that you can deduct some or all of this. For example, mileage, there is no cap. If you're in a high mileage, sales-oriented role, probably driving all over creation, deduct that mileage, deduct every mile you can. That's truly legitimate business expenses. But then we get into more complicated things that aren't necessarily as well known, or if they are well known, thanks to other social media influences out there, I see them implemented incorrectly or barely implemented at all. Things like the home office deduction, or specifically the Augusta rule home office deduction, where you can take a section or a rental of your own home from your business, and it's tax-free income to you if it's 14 days or less per calendar year, and a deduction to your business. Completely legitimate, but you have to do it the right way, and documentation is key. Same thing with, say, for instance, hiring your children. If you're lucky enough to have kids, and lucky enough that those kids want to work for you, and they can do so from a younger age than you might think, then let's make sure that we're taking advantage of that, teaching them the principles of the business that you have founded, getting them on payroll so that we're running it through the correct way, and also making sure that it's done legitimately so that if the IRS ever does come knocking, you have all of that documentation to back it up. We just released a couple of videos here in recent weeks on exactly how you can do that, so if you're interested in that particular strategy of hiring your children, go back and watch our last couple of videos for a few unique tips and tricks, especially if you're an S Corp or a C Corp. So with those three in mind, if this is something that you're an entrepreneur and this video has you thinking about your financial situation, we'd love to hear from you, and you can drop us a line to learn more, or in the meantime, like and subscribe on the channel so you never miss another video. And in the meantime, we'll see you out there.